through some of those things. So first off, everyone, thank you for joining our quarterly call, Zoom call now. And if you see on your screen right there, if you take a picture with your phone, or you can go to slido.com, and that's where you can enter that code there, and that's where you can ask questions that we will try to get to here after a bit. So without further delay, Jordan, first off, thank you. For those of you who maybe recognize Jordan Juenemann, I'm going to let him tell his story and background. I think there's a lot of people in this area who probably recognizes the name. So Jordan from First Eagle Investments, please share a little bit, if you don't mind, just kind of your background and what keeps you in Kansas City.
Yeah, Don, thank you. And thanks for having us on. And it's a pleasure to see everybody. And as Don said, my name's Jordan Juenemann, and I'm local here in Kansas City, originally from Kansas, and represent First Eagle Investments in Kansas and Missouri and work with financial professionals like Don. And I'm coming on my 6th year at First Eagle, incredibly proud to represent them. Don and I have a connection through basketball. I played at the University of Kansas under Bill Self, Hall of Famer Bill Self, 2008 to 2012. And my senior year was part of the runner-up national championship team. We lost in the final to, I say, Anthony Davis. It was really because of him of losing the final game, but definitely really fun to be a part of that during the college experience. And kind of like I said, if you don't go pro in your sport, there's you have to find something else. And so being a part of investment management and working with amazing professionals like Don is part of it. So now a little bit about First Eagle. First Eagle as a firm has been around since the 1860s, but our main flagship strategy, First Eagle Global's been around since the 70s. So almost for 5 decades, 50 years, we've been managing on behalf of our clients. And really our job at First Eagle, or what we're known by, is being that go-to global and international investor. We like to say at First Eagle, the U.S. does not have a monopoly on amazing businesses. And there's way more stocks outside of the U.S. And that's something where a manager like us, we sift through and try to uncover very high quality value opportunities. And I think right now it's really relevant where you're seeing kind of investors move to other parts of the world, the dollar kind of weakening. But really First Eagle, we take a value approach, try to be prudent stewards of capital, and somewhat really the epitome of Warren Buffett in an investment strategy. One thing that First Eagle does different is we always keep some gold on hand and use gold as a hedge and view it as a scarce asset. Something that makes us very different. Gold has obviously have been rewarded in this market, and something that distinguishes us. But you have investments in First Eagle, you have exposure in gold, and with one of the largest holders in the country. So that's about First Eagle. We have our best, Anirudh Kirtane. Anirudh is the head of applied research at First Eagle. And we have some dedicated slides that we're going to go through. Anirudh, I'm going to share those. But Anirudh, thanks so much. Anirudh's going to cover kind of current market dynamics. And Don's going to interject too, so with some points and questions. And two, any questions that arise, please submit those, and we're going to get to them as well.
We'll get to them. Thank you, Jordan, for the introduction there. And Anirudh, again, it's our pleasure to have you today. And I'm sure you got a little bit to talk about with everything that's going on and the uncertainties in this marketplace. So please share a little bit about your background, and then let's just jump in and try to get through some of these pieces of information.
Yeah, sure. So thanks a lot, Don, and thanks for everybody joining the call today. So I joined First Eagle about 9 years ago. Prior to that, I was at Prudential, PGIM is what it's known now. But my background is that of a due diligence analyst. I used to select managers and build portfolios on Prudential's platform. And when I came over to First Eagle, it was to sort of analyze markets and portfolios for the benefit of our clients and also our senior management and our board. So what we're walking through today is very similar to what I've done for almost 20 years now. But look, it has been an exciting time in the markets. I know Jordan's going to pull these slides up. I just hope that the data on these slides is still relevant given what's been going on. I feel like I have to update these every hour. But look, I'll try to just be brief and talk about what I feel is going on in the markets and what we see at First Eagle. And so I'm going to start with a chart that's somewhat optimistic, even though when you look at the markets, it's completely red. And so what I'm putting on this slide is what we call market breadth. And so if you think about market breadth and you look all the way to the right, that 60% bar in 2025, that means that 60% of stocks in the MSCI World Index are outperforming the MSCI World Index as a whole. So in other words, there's a lot of places to go, or more than 50% of stocks to pick from, and you can outperform this year. That has not been the case for the better part of 5 years. So if you look at 2024 and 2023, you could see only 29% and only 33%. And most of you are probably familiar, this is that whole Mag 7 phenomenon, where if you weren't invested in those handful of names, you just simply weren't going to be able to outperform markets. And so it was a very difficult environment for a lot of managers who, even if you were in those names, but if you weren't at an index weight in those names, it was just going to be difficult to keep up. And so from our perspective, this broadening of the markets is a healthy thing for a diversified investor and someone who's focused on names beyond just those handful of Mag 7 or US technology names. But with that, let's look at the data. And so this is where, again, I'm going to have to update this after today because this data is returns data. The way to read this chart, there's a lot of numbers here. But on the left-hand side, we've got equity markets. On the right, upper right, we've got fixed income. And then the middle right is real assets. And what I did in terms of the columns is, the first column is what happened in 2023 and 2024, those narrow market environments. And then the second column is what's happened since that Liberation Day announcement of tariffs. And then the third column is year to date. This is as of the end of last week. So again, I'm gonna have to update this. But the real takeaway is that we've seen some tremendous reversals relative to what happened in 2023 and 2024. So if I can fixate you on the upper left, that Bloomberg Mag 7, those stocks are up 250% in 2023 and 2024. Year to date, they're down about 20%. And the opposite is true a couple of rows down. You can see international markets. International markets were only up 23% in that 2023 and 2024. And while the S&P's down year to date, international markets are up 5%. So we've seen tremendous reversals in favor of non-US stocks, in favor of non-Mag 7 stocks. Frankly, value stocks have done better than growth stocks. And on the middle right, you can see the steady eddy throughout all this has been gold. And so Jordan talks about how we view gold as a multi-purpose hedge asset. And that's really come to the fore, not just year to date, but over the last couple of years. The last comment I'll make is that fixed income, and particularly safe fixed income, if you look at that middle column on the upper right, has not provided the ballast that most people have expected out of fixed income. And so we'll talk about that in a few slides, but I thought that helps paint the picture.
Yeah, let me ask you a quick question, if you don't mind. When I'm looking at international markets, I mean, it's no different in the U.S. markets in terms of big companies, mid-size, small size, emerging markets. Right now, where do you think the direction, I mean, with all the tariffs and things that are happening, do you like the larger names or do you still like some of the growing markets?
So I'll say that, I'm going to answer your question directly, but I want to say this about our investment approach. We think that it's critical that you're selective about how you pick international stocks. And the reason I say that is because there is, as much as the US is out of favor year to date, there really is something to the story of US exceptionalism. We've had the deepest capital markets. We've had the most robust legal system. We have the innovation in our tech sector. And so there's a reason why US markets have run ahead for so many years. And then there's political issues in international markets, whether it's emerging countries, even developed Europe, they've had issues. And so our approach to international markets is to be extremely selective. That means company by company. And we're not going to take an overall view on, hey, this is the time to be in international large caps versus small caps, or we're going to pile into a specific country. I will tell you this. Our emerging markets allocation, again, as a result of those bottom-up stock picks, is about as high as it's ever been throughout our history. And we are also looking in countries like the UK, which has been out of favor. That's also about as high as it's been. But I want to be very clear that it's not a call on either one of those companies or areas. And Jordan, you know what? If you can go to page 7, I think this will just illuminate it. When you look at valuations internationally, the non-US valuation, so this is the middle column, this MSCI column. The current valuation is 13.2. You look at how that compares, that is basically trading at near recession valuation. So the subsequent few rows here were the valuation bottoms in the previous 3 recessions. And you can see we're at spitting distance from those. So international markets have been so unloved for so long that even though they've done well year to date, you're still sitting at very low valuations relative to, let's say, US markets, which is on that left-hand side, which at a 19.5 is still significantly above its 13.7 recession bottom average.
Right. Now, the PE on US S&P, it's dropped from what highs in the 25, 26 range. Is that about where at market highs?
Yeah, that's right. And I even think the US approach should also be selective. So for example, if you looked at a dispersion index within the United States, it was really those tech Mag 7 names, which were extremely overvalued. So Jordan's pulling this slide up as we speak. If you go to Jordan, there it is right there. So this is a little complex to understand, but let me just walk you through it. On the left-hand side here, we are looking at the dispersion in value between the most expensive stocks and the cheapest stocks in the S&P 500. And if you just look a little bit, don't look at the most endpoint, but look a couple years back, like 2020, 2021, you can see that the highest names in the index were so expensive relative to the lowest names in the index. That's the distance between the top of the purple area and the bottom of the purple area. So if you look at where we are now, you've seen that froth definitely come off a little bit, but it's still really high relative to where the average is for those top names. So in other words, yeah, we've dropped from a 25 to a 20, but we're still pretty stretched in certain areas of the US indices.
Makes sense. So the question then leads to, is now a good time? Do you think we're towards the bottoms of these markets? Is it a good time to move cash into whether it's US stocks or even international? What's your thoughts?
Yeah, so why don't we go to Jordan? Why don't you flip to page 11? So in this section of the presentation, we're talking about why some of these reversals that you've seen can persist. And let me just spend time, and then Don, I will come back to your question on this.
Yeah, great.
But we showed in that index return page how some of these things have snapped back so strongly, whether it's non-US stocks, whether it's value stocks. But what I want to highlight on this page is if you look at non-US versus US, that's on the left side, or value versus growth, that's on the right side here. Even though we've had tremendous year-to-date outperformance, it is and you can see that there's a little tick upwards where Jordan is pointing to, that red arrow. But that is just a mere drop in the bucket relative to how poorly international has done for the better part of a decade. And so it gets to the point that despite international rallying this year, it's still cheap. And it still has got a way to go. Even if it doesn't catch all the way back up, you could still see this persisting. And the same thing on the right-hand side for these value stocks. So they've been unloved for a long period of time too. We saw a little bit of a kickback in 2022, but then in 2023 and 2024, it went back down again. And now we're seeing a little kickback again. So if you are, so then this gets to my point about answering your question, Don. I think if you have a selective approach, it absolutely is a good time to start thinking about investing. Our funds have done exceptionally well year to date. So in our global fund, we're up when the market's down. Our international fund is up close to 9% year to date. So if you have that selective approach, there are places to add value. You saw that in the market breadth slide improving, and you see that here with some of the reversals. But I think I think one has to be careful about what stocks you're picking, where the valuation is, and where the prospects are good.
Yeah. Now, does the declining dollar, is that helping you or is it hurting you, would you say?
Yeah. So right now, I would say that everything is working for our investment process. And when I say everything, here are the four. Number one, international is outperforming the United States. Number two, as you said, the dollar is down. And so the reason that helps is because you get not just a tailwind from your stocks going up internationally, but the currency translated back into dollars also helps you. The third thing that's helping us is this value growth rotation. We are known for being sort of focused on value and paying the right price. And then the fourth thing that's helping us is gold. So that's why in a market where broad indices are down, our global fund is up, even though it's, call it 80% invested in stocks, 75, 80% invested in stocks.
Sorry about that. I had my mute on.
Okay.
Thank you. Yeah, thank you for that. But so one of the things, 30 some years in the industry, you start seeing high inflation that we had, experienced the last 12 to 18 months. I mean, is gold still, in your opinion, a good place as a safe haven? Do you think it's something that's going to last for another 12, 18, 24 months? What's your thoughts on gold, basically?
Yeah, and Jordan, while I'm speaking, why don't you bring up slide 14 if you don't mind? So look, I think I want to be very clear about the way we use gold. So we don't make a directional call that we think gold is going to X over the next 6 months or gold is going down to Y over the next 2 years. Our view on gold is that it's a multi-purpose hedge. When equity markets are drawing down, gold tends to do well. When currencies are in trouble, gold tends to do well. So when the dollar is not doing well, gold tends to do well. When there's geopolitical concern, Ukraine invades Russia, or is Iran doing something with a bomb, that also favors gold. So and then inflation you mentioned. So there's a lot of uncertainty in markets right now. Whether you think about markets or equity markets, credit spreads, currency, geopolitics, tariffs, there's so many different things that are creating this uncertainty premium. And I think that's why gold has done so well. For us, it remains about 15% of our portfolio because it is working as a hedge. So we're still convicted in it as this hedge for its hedge qualities, but we're not necessarily calling it to jump to a certain level by the end of the year. The reason I brought this slide up, though, is because B of A just last week does, from time to time, they do this global investment manager survey. And they ask their managers, what do you guys think about trends in the market right now? And so if you look at the upper right here, the asset class that most investment managers are picking to be best performing in 2025 is gold. You could see that it's up from February, March, and then in April, especially as Liberation Day came, you could see this jumping. So look, sometimes one might think, is this a contrarian indicator? Who knows? But the point is that many of the so-called smart money folks are looking at it as a multi-purpose hedge in an uncertain world, and that's certainly how we look at it.
Do you think tariffs will have help or hurt on whether it's gold or, I mean, just kind of what's your thought process there? I mean, obviously it's a transformational time period is what we keep hearing. I'm just curious how that's going to play out in some of these international type holdings.
Yeah. So I think Jordan, if you go back one page, I think what we are looking at closely And I think this isn't just us. You've seen probably a lot of headlines around this, but let me just walk you through this slide real quick. So on the left-hand side, the green line is the dollar index. And so, Don, as you mentioned, the dollar's been going down steadily this year. The dashed line is the 10-year Treasury yield. The circled area is what I want you to focus on, because it is pretty rare for markets to be selling off like equity markets have, and both the dollar not doing well and 10-year Treasury spiking. That means bonds aren't doing well either. And the reason I think this is important is because it seems to be saying that there's just a general flight away from anything US. So clearly US equities are going down, but also dollars going down, and then US fixed income is going down. And so I think to answer your question, Don, there seems to be some sort of a tariff uncertainty premium that is playing in the minds of investors and markets, that maybe US assets just in general are not as attractive as they used to be because of this tremendous amount of uncertainty around what is the US doing with their tariff policy? What are we doing with our fiscal policy? Are we going to have inflation? Is Trump jawboning Powell, in a way that is not helpful? So there's just a lot of uncertainty around the US markets, and that's playing out in how dollars and fixed income are behaving. And then the other thing, I think, I don't want to belabor this too much, but if you look at the right-hand side, this is an important thing to keep an eye on. And this is foreigners' holdings of US treasuries. And the blue line are official foreign entities. So think of central banks. And then the lighter blue line is just all foreign holders. And you can see that official central bank holdings of treasuries have actually been coming down for a couple of years now, really sort of coincident with when the Russia invaded Ukraine. And you can see a slight tick down in that lighter blue line. Jordan's highlighting it right now. This is something to really keep an eye on, because this is a signal as to whether or not there is this uncertainty premium for US safe fixed income assets. And does that put more pressure on the US economy and the US, just sort of US assets in general?
While we're talking about that, I mean, what's your thoughts on rates now? I mean, is it going to take the Fed? Do they need to step in now? I mean, I know they talked about a couple rate declines later in the year, but do you think it's about to the stage they need to start making a move?
It is such a tough question, Don, and I think that's why you're seeing Trump and Powell fighting. On the one hand, Powell got burned from potentially waiting too long to raise rates, and
right.
We had an inflation spike, and so I think a lot of folks are loath to raise rates, especially in a tariff regime which may be inflationary. And so he's seemingly holding that line. On the other hand, the odds of recession continue to go up and up and up because of tariff policy, or potentially because of tariff policy. So this sort of dual mandate of the Fed, we have to prevent inflation, but then if recession is bad for employment, then do we cut rates? And so you're seeing that it's really, you're between a rock and a hard place. If I cut rates, is that inflationary, and is that going to add to the inflationary nature of tariffs? But if I don't cut rates, then does recession come without any defense against it? So that's why a lot of people are throwing this word stagflation around, which is when you have inflation plus low growth. And it's a real dilemma for the markets and Powell right now, especially as Trump starts to jawbone him even more.
Yeah. So what's your thoughts as far as recession? I'd say it's about a 50-50 blend out there of people thinking we're heading to recession or we're not. I still want to believe that about 2 years ago, we were basically in recession then. I mean, times seemed tougher, I felt, at least for, the people that I work with. So what's your thoughts? I mean, do you think we're definitely going to get there this year, or you think we're going to be able to escape it?
I mean, look, it's such a difficult call to make. Economists get this call wrong all the time. So that is not our expertise. What we're good at is picking stocks. But I will say, if you look at the data, and that's what Jordan brought up here, the Atlanta Fed GDP Now forecast is the most sort of real-time measure of where we are in GDP. And you can see it falling off a cliff and going negative. So according to the GDP Now forecast that the Atlanta Fed runs, we're already in negative growth territory. If you look at this, again, this investor manager survey that B of A does across its global investment management community, you can see where we are in April. This was, again, last week it was released, but we're at about 42% of global investors think that global recession is coming, and that's the fourth highest in the last 20 years. So we've got clear indications of that. I think anecdotally also, if you listen to company management on earnings calls, they're all talking about it's impossible to plan in this environment. Private equity exits have dried up. So there's tremendous amounts of evidence to suggest that the trajectory that we're headed on is not great. And, you know, I think that's what's showing up in equity market environment performance as well. So it's a tough environment right now.
Yeah, that's one you don't want to bet too much money one side or the other, because regardless, somebody's going to be wrong for sure on that.
Yeah, and I think where it leaves me is, Jordan, if you go to page 16, you know, there's so much noise right now, you know, it's almost overwhelming. And so this slide, it sort of summarizes to me what end clients should be thinking. And it's certainly the First Eagle way. It's that when you look, let's ignore this noise and keep it simple. And what does that mean? Firstly, diversification does matter. For many years, it felt like it doesn't matter, just be in the US. The US is the place to be. You don't have to own anything else. But it's incredible how quickly things can change. And then you sort of wish, hey, maybe I should have had a little more international in my portfolio. Maybe I should have had a little more value in my portfolio or gold in my portfolio. So keep it simple, make sure you're diversified. The second is that fundamentals matter. So listen, Mag 7 can rip, and these stocks that are tremendously valued can rip for a long period of time. But when uncertainty hits, what matters is what am I paying, and what are the earnings growth prospects? And am I buying it at a price that is worth the quality that I'm buying? And then I think the third point is, do you have these type of all-purpose hedges in your portfolio to protect you? And that's where gold has really helped us out a lot this year. So that's, to me, it's keep it simple, ignore the noise, stick to your basics.
You know, that's been the basis of my business through the years. And it's really, you know, for tough times like right now, having those uncorrelated asset categories, having that good balance. And I think in times like this, it's extremely important to make sure you keep that diversification. I really believe that's probably still the biggest, in my opinion, to client success in their portfolios. So that's great. We're getting closer. We've gone about 30 minutes here. If you like, I mean, if there's another 1 to 2 pieces of information you'd like to pull out, please do so. And then we've got a couple questions that I can throw your way. Some of them we've been covering as we've gone on, tariffs and the recession. So those are the big things today. It's a definite market uncertainty. So I'll let you go ahead, and there's a couple more categories.
Yeah, maybe I'll just finish with 2. And Jordan, why don't you go to page 9 first? Yeah, actually, that was the other one. Good. We're on the same page, Jordan. So page 9 here, one thing I just wanted to highlight is that this is an interesting one for me, and it gets to the point of inflation that you were asking about, Don. And so on the left-hand side, we've got a survey that the University of Michigan does for consumers in terms of what are your inflation expectations. And then on the right-hand side, we've got market-based measures of inflation with a little further out time frame. So it's what do you expect in 5 years the inflation to be for the subsequent 5 years? And the reason I think this is an interesting slide is because investors, or sorry, I should say consumers are really pricing, this is the left-hand side, are really saying, wow, it seems like this tariff stuff is going to have a really negative impact on inflation. And that's where you see that red circled spike going up. But markets, the bond markets, are saying, you know what? It's going to be a transitory thing. And it's not going to have a long-lasting impact. And so whether they're discounting that, tariffs won't actually get implemented the way that they say it's going to be implemented, or they're saying that it's going to be a one-time hit to prices, this is an interesting thing to keep an eye on as an investor, but also as a consumer. And so I think that it just adds to this level of uncertainty in the markets that it's just really hard to understand or make a call on where any of these things are going.
So if you're sitting there with cash on the sidelines, you waited, you either did like Warren Buffett and pulled money into cash, a while ago, or what? But if you're sitting there with cash, would you think now from a time to dump money into the market? You still like dollar cost averaging over several months? How would you go about it for your own business?
Yeah, look, I'm not a market timing guy because I don't think I have the ability to make that call. What I do think is that it makes sense to dollar cost average. It makes sense to look at areas of the market that are trading at reasonable valuations, where there's quality. And I think, Jordan, if you go to that slide that you were pulling up before, I think this slide really sums up why international has done well when uncertainty is returned because of the fundamentals. So this is a place where it makes sense to dollar cost average. We've been doing it for a while now, and we've been rewarded. So on the left-hand slide, you are seeing the earnings growth trends for the S&P 500 in the dark blue, and then all non-US stocks in the light blue. And what you see is that the upward in the light blue, meaning the earnings growth trends look favorable for non-US markets and unfavorable for US markets. Again, particularly after it became clear that tariffs were going to be in play. And then on the right-hand side, you're looking at the valuation difference. So this was just another way of showing what we showed on that previous table, where US markets are still at a 19, international markets that are 13. And so if you add up these two charts, what you're seeing is that international stocks trade at significantly cheaper valuations, and the earnings growth prospects look more positive. And that's why diversification has really worked when uncertainty in the United States has been introduced. So yeah, keep it simple, dollar cost average, and make sure that you're picking the areas of the market which potentially haven't gotten the love.
Yeah, and I definitely agree. Market timing, fortunately, it's not been something I'm necessarily the best at. So I just try to take that off the table. We're not going to try to time it. I totally agree. Dollar cost averaging. If you have a little bit extra, maybe you dump a little bit more in right now. But I do agree. Dollar cost averaging is the best approach. Jordan, as you
agree with this, but
yeah, go ahead. I'm sorry.
I was just going to say that I think it must be said, though, that we're not out of the woods, so the uncertainty persists. The news is I don't have to say it on a day like today, but, the point is that no one can call this bottom. So, we'll see what happens, but that's not why you do it. You don't try to time it.
Yeah, and I'm one of those right now, and nobody likes what we're going through right now. I mean, it doesn't matter political or not. Nobody wants to be in the time period we're in right now. But I have this belief that I really think that once we see the first tariff deal, and it's kind of like a football draft, and they wait for the slotting system, they wait for those top 3 to 5 players to get slotted in on a pay, then everybody falls in line. And I kind of think that's what's going to happen in this tariff race right now. I think once, if it's Japan or somebody, once we get that initial one, I think everything will calm down from there. What's your thoughts?
I love that analogy, and I think it's spot on. I think that the market is craving any type of certainty on anything, tariffs, monetary, fiscal, you name it, things feel uncertain. And so I think the market craves that kind of certainty, and then that will be the sign of, maybe we're at the beginning of the end of this thing.
Yeah, I hope it happens, quicker or sooner rather than later, I should say.
Yeah,
make for a lot easier days in the markets and stuff.
that's right.
Jordan, do you have any thoughts? Anything you would like to add in? Anirudh's been great. I appreciate it. So
Yeah.
anything you'd like to add at this
You,
point?
the one thing that's interesting is that this dollar weakness of, what we've really known for the last, post financial crisis is the dollar to be stronger than other currencies, and our economy, as Anirudh has mentioned, is rightfully so. But now being 10% off its highs, gold globally is priced in dollars. And so European investors, Asian investors can buy 10% more gold than they could. And so it's kind of a continuation of your currency gets stronger, you can buy more of the commodity of gold. So that it's kind of an interesting point relative to that asset. But I think it's a welcome sign where you're seeing there's valuation in the market and dispersion among stocks, and I think it just pays even more why you have a professional and a plan in place, and to dollar cost average and to be diversified. It's really showing up here recently.
Yeah, and I really think markets like this, you have to have the patience. We can't try to time this. We've been through them before. Are we going to come out of this one? I tend to believe we are, and I still think we're going to see positive returns in the markets this year. Now, do I think it's going to be double digit? Maybe not necessarily, but I think we can still see a positive year in these markets. And again, I think a lot of it has to do with the tariffs right now, and are we going into recession and those things. But personally, I feel, I'm not ready to sell out of this market, is what I guess I'm trying to say.
Yeah, there's not often periods you get it down 20 to take advantage of, even though.
No, right.
So,
I always
selling out is timing the other way, right?
Yeah. It's a good way of saying it. It really is. That's a good call on that. So, well, if there's any other, Mason, I don't know if you have the ability to put that other Slido screen, and I'll give everybody just another minute or two. And if not, what you can do is if you're in your computer or on your phone, go to Slido. There you go, slido.com. You can put in that code, and then feel free to send over some questions. But so to kind of summarize, as we're kind of towards the end of this call, any last second things? I mean, if you have these pearls of wisdom that you want to share with some good Midwestern, people here, what would be that wisdom you would want to share right now?
Oh man, that's a lot of pressure. Look, I'm just going to go back to those bullets on that slide where don't panic. I think keep it simple, ignore the noise, make sure you have a plan and stick to it. If the plan needs a little bit of adjusting or tweaking, that's fine. But panic and massive moves in this type of a market just seem to me to be reactionary as opposed to an intentional, thoughtful way to invest. And so ignore that noise, be diversified, pay attention to fundamentals. And if you want, up the sort of hedges a little bit in your portfolio if you're really worried. But I wouldn't do anything drastic. And certainly, hopefully, you trust in the professionals that you have.
Yeah, and I think that's exactly right. Just kind of the importance of sticking with your plan. Don't get crazy one way or the other, and just at the same time, maybe not watch the news every day. That's part of it, to see there. Well, I want to say thank you to both of you. I've tried to interject questions and removed them as we kind of been talking through here. So I want to say thank you, Anirudh, I'm sorry. I really appreciate your style. I like just down to earth sort of approach. So thank you for that. You're obviously a little smarter guy than me at times. So
I don't know about that.
I love when guys like yourself can actually put it into terms someone like myself can understand. Jordan, thank you. You're a good not only friend, but you're a good business colleague. And as we continue to build our positions in your couple of your holdings, you'll see more and more of those clients who are on this call. You'll start to see more and more of their names, piling in on the list here soon. So I want to say thank you.
Thank you, Don. It was excellent.
Thanks
Yeah,
a lot.
I appreciate it. I try to keep these short, sweet, so people will continue to tune in about once a quarter. So anyway, thank you both, and I appreciate it. And hopefully we have a great rest of this year and some improvement.
Thanks very much, Don. Appreciate it.
Yep. Take care. Have a good week, Don.
Thank you. You guys too. Appreciate it.